The week that started on optimism backed by a slowdown in US inflation last week, saw the winds reverse sharply in favor of the hawks. The Federal Reserve, the European Central Bank, and the Bank of England rate cut expectations melted throughout this week. Oil and commodities sold off. Only Nvidia lived up to the bulls' lofty expectations this week. So, thank God it's Friday. This is Swissquote's Daily Market Talk. So the week hasn't been good for the market bulls, to say the least. On Wednesday, the FOMC minutes show the shocking and disturbing truth that many Federal Reserve members wondered whether keeping the interest rates high for longer in the US was sufficiently restrictive to tame inflation, and if hiking the interest rates wouldn't be a better idea. Then the UK PM Sunak announced a general election beginning of July earlier this week, and that's way earlier than many expected because expectations was autumn, abating the slightest glimmer of hope to see the Bank of England cut its interest rates in the June meeting. Meanwhile, the latest British CPI data came in hotter than expected earlier this week as well, warning that the policy easing in the UK wouldn't necessarily be on the pipeline for June anyway. Then, across the channel, the data released this week also show that wages growth in the euro area increased 4.7% in the first quarter, a red flag for officials who have been banking on a slowdown to keep inflation in check. And finally, a set of too strong to be pleasant data from the US gave a final punch to the bulls yesterday because the services PMI accelerated way faster than expected by analysts in May, according to the S&P's preliminary PMI data, and manufacturing activity also improved. Meanwhile, jobless claims came in soft. As such, yesterday's data from the US came to back the hawkish central bank worries. So the 2-year yield, which captures the rate expectations, advanced to 4.95% level. The 10-year gilt yield reached 4.25%. The 10-year bond yield hit 2.60%. The S&P 500 and Nasdaq sold off from a record high. The SOX 600 index managed to eke out a small gain, but the FTSE 100 index is down by more than 1.5% since last week's peak level, hit by a decent decline in energy prices as well. So voila, in this respect, the US crude extended losses below the 100-day moving average for a third consecutive session and is now set for a further fall toward the $75 per barrel psychological level. Earlier this week, the US Department of Energy announced that, they will release 1 million barrels of gasoline from the Northeast Gasoline Supply Reserve to, help relieve prices at the pump for Americans. But many people out there think that the release of 1 million barrels of gasoline will not matter much to the overall market, as East Coast region burn around 3 million barrels per day. So the 1 million barrel release from these reserves will be just a drop in the sea. Elsewhere, copper futures gave back almost 10% since their Monday peak, and gold lost more than $100 per ounce since Monday record level as well. So if the reflation trade loses momentum due to a hawkish shift in major central bank expectations, we shall then see a period of pullback and some profit taking in risk and reflation-friendly assets, and a further dollar appreciation against major counterparts, because although the European Central Bank and the Bank of England rate cut expectations are also getting scaled back, while the hawkish voices for the Federal Reserve are rising higher than the rest. So swaps now fully price 125 base point rate cut from the Fed for December instead of November, and the probability of a September rate cut from the Fed is down to a coin flip. Of course, happily there is one bay that still remains very much and well protected from the strong hawkish winds, and that's Nvidia. because Nvidia jumped more than 9% at yesterday's trading session after beating revenue expectations for the first quarter and exceeding the forecast for the current quarter. The after-hours reaction seemed rather meager, remember, but the stock finally gave slightly more than suggested reaction by option prices. So Nvidia is now catapulted to the overbought market territory following yesterday's strong post-earnings rally, but investors are too happy and just too hungry for more to take profit just a day after another set of blowout results. So at this moment, nothing really suggests that the company's good fortunes or demands for AI are about to reverse. So the rally is on, guys, and there is now a good chance that the $1,000 per share psychological level for the Nvidia stock becomes, well, a new depth for those who are still willing to jump on the back of a bull. Now back to earth. The US dollar index strengthened past the 50-day moving average following the hawkish federal minutes of this week and yesterday's strong economic data. The euro dollar slipped below its own 100-day moving average and is now preparing to test the 108 support to the downside. Cable is below the 1.27 level and could reasonably expect it to extend losses further on the back of fading appetite for sterling before the general election that's due on July 4th, while the dollar yen is now back above the 157 level. Inflation data out this morning from Japan showed, well, a slowdown in core CPI to 2.2% level, ruling out any sense of emergency for the Bank of Japan to continue hiking the interest rates. And the Aussie dollar actually tipped a toe below the 66 cents mark this morning and could lose the latest positive momentum if the pair slips below 0.6580 level, the major 38.2% Fibonacci retracement on the latest rebound. Now in cryptocurrencies, well, this week was quite full of news of different kind. First, well, Donald Trump decided to accept donations in cryptocurrencies for his presidential election campaign, demonstrating President Trump's success as a champion of American freedom and innovation, said his website. But appetite in Bitcoin waned this week along with the rising hawkish Federal Reserve expectations, and the coin remained offered near the $70,000 psychological mark throughout this week. Then 8 spot Ether ETFs were approved by the US SEC yesterday. Ethereum flirted with the 4,000 psychological mark after the news, but enthusiasm regarding the spot ETFs on the world's second largest cryptocurrency by market cap is nothing compared to the Bitcoins. One of the major reasons for that is that, well, the SEC is apparently concerned about staking. Therefore, many Ether ETF issuers like ARK Investments and Fidelity removed their staking plans from their spot ETFs. So the latter doesn't necessarily please investors. And beyond the staking issue for the ETF approvals, well, it is said that demand for spot Ether ETFs are relatively low, around 10 to 20% of the demand for spot Bitcoin ETFs. Therefore, many institutions out there don't even bother issuing a spot Ether ETF. Still, the approval of Ether ETFs is just another step forward for the cryptocurrencies and the sector altogether. And well, I like Ethereum just better when it comes to cryptocurrencies because it does have this platform to allow businesses to issue their own tokens, and it does actually offer them the possibility to shift towards decentralized finance, a thing that Bitcoin doesn't do. So the fact that there is a real business model in Ethereum actually makes me think, or makes me feel, that if cryptocurrencies were to become a big thing, a big revolution in finance, well, Ethereum should be, in theory, fundamentally, in a better place to thrive. But that's just me. So this is all for this week. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.